Now, Doug Cliggott is Credit Suisse's U.S. equity strategist, and he is one of 14 strategists of the major brokerages that we survey for their outlooks. Doug, welcome to Close. Thanks for joining us. You see a pullback coming here in stocks, and, of course, we had a down day today. Why is that, and is this the start?
We don't think it's the start yet, Matt. Our base case is that when the Federal Reserve ends its large-scale asset purchase program, and they're scheduled to do that on June 30, that when they pull back from buying, 15 to 20 billion in assets every week, like they're doing right now, that will have a negative effect on asset prices in general. And when we look back at the middle of last year, sort of what happened when they finished their first so-called QE1 asset purchase program, the S&P pulled back pretty significantly.
Hey, Doug, hang on for a second.
We don't think it's going to be...
Doug, hang on, because you sent us over a great research report and a great visual. I want to bring it up for our viewers because you look specifically what you're talking about, the S&P 500, and for everybody who's watching, that's the white line, and then you compare that with what's going on the Fed's balance sheet. That's the yellow line. They really are very much in sync. No surprise, I guess, perhaps.
Well, and I think the idea, Carol, is, the order of magnitude of their purchases. This second purchase program is equivalent to $600 billion. Another way to look at $600 billion, that's more than 3 years' worth of average total mutual fund purchases by Americans. So this is a lot of money coming into the market in a fairly brief period of time. So we just think it's common sense that when they stop those purchases, you're going to get some kind of a pullback.
Why don't you think, though, that they'll be able to cushion it, which is, I'm sure, what they think that they can do, or even come out with more, which a lot of people that we've spoken to on this program think is coming, QE3, and Mark Faber has even said QE26 is someday on its way.
Well, there are some investors, Matt, that are sort of counting on a QE3 or 4. I think one real complicating factor right now is it isn't just the S&P 500 that's reacting to a bigger Fed balance sheet. We're seeing commodity prices, not today, but over this time period, go up a lot. But in general, I'd say the key constraint here is inflation. We've seen food prices accelerating, energy prices accelerating. We were looking at prices of non-petroleum imports. They're rising at more than a 4% annual rate right now. So sort of the cost benefit to the Federal Reserve of, going beyond what they've already got planned, it's not clear it's going to be a net positive for the economy.
Hey, Doug, it's Julie here. Thus far, when we've been getting earnings from companies, they've been quite strong. And thus far, we've seen them, by and large, able to pass some of those costs on to their consumers, enough that the margins aren't getting too squeezed. Where's sort of the threshold where that changes? Or do you think corporate profits are going to continue to be strong for the balance of the year?
We think profits are going to keep growing, Julie, but we don't think there's going to be much in the way of margin expansion now. When you look at the parts of the market that have been doing well year to date, healthcare, consumer staples, industrials, these three sectors have a very high correlation of their earnings to the dollar. So I think part of what's going on with the good earnings is the weaker dollar. And so that's going to lift up revenues and keep earnings growth good. But we think we're sort of near the end, if not at the end, of the improvement in margins that really started 2 years ago.
Here you see, by the way, the dollar index coming down, down, down. And I guess there's no other way for that to go unless you see rates actually rising. Do you see that on the horizon, Doug?
Not anytime soon, Matt. I think what we're expecting, again, is that the Federal Reserve stops growing its balance sheet at the end of June. But again, given how sluggish growth has been, given how high unemployment is, and given the fact that the Federal Reserve is trying to accomplish these two tasks of maximizing employment without letting the inflation genie sort of get out of the bottle, I think we're a ways away from actually seeing short-term interest rates going up.
Do you think
so? That's not really the concern. Again, our concern is we think PE multiples come down some when they stop growing the balance sheet.
You know, it's interesting, Ben Bernanke in his first press conference last week saying that they really don't have, monetary policy doesn't have a direct effect on unemployment. So inflation would seem to be the one of their two mandates left that they can actually do something about. Do you expect the Fed to keep inflation under control? Because people at home obviously see it spiraling upwards already.
They do. And again, it's at least so far, it's been primarily in the food and energy area. I want to believe, I guess I do believe that the Fed will act to slow growth down if they do sense that those inflation pressures are really starting to broaden out. We haven't got there yet, but I think we're starting to see some, little yellow flashes of, as I mentioned, looking, for example, at the non-petroleum import prices, they're starting to accelerate right now. Time will tell, but, the Fed's had a good record really since Mr. Volcker of not letting inflation expectations really get too high. And I think they're going to, keep in that mindset.
We got to run. Doug, good to get some time with you this afternoon. Thank you so much. Doug Cliggott, U.S. equity strategist over at Credit Suisse Securities.